Well, hello and welcome to this Moneycontrol live stream. You're watching Morning Trade with me, Nandita Khemka. Well, over the next 30 minutes, we'll be talking about how ONDC is looking to disrupt the food delivery market. We'll be talking about the cues for trade today, all the stocks in focus, the results to watch out for today. So lots lined up over the next 30 minutes. And of course, we'll also be getting all your stock-related queries answered by our technical expert on the show. So if you have any queries, send them in to us on our YouTube feed and we will have them addressed. But before we do all that, let's take a look at the top headlines at this hour. Wall Street ends lower ahead of the release of key CPI inflation data for April. US President Joe Biden says the US defaulting on its obligation is not an option. But a meeting with House Speaker Kevin McCarthy ends with no signs of progress over raising the debt ceiling. Asian markets open largely lower. The SGX Nifty, however, is signaling a positive start for the Indian market. L&T may beat its FY23 growth guidance on the back of strong execution and order inflows when it announces results later today. Meanwhile, Dr. Reddy's too is likely to report strong sales growth in the fourth quarter, but its US business is likely to remain under pressure. And voting kicks off for 224 seats in the high-stakes Karnataka Assembly elections after a 40-day campaign ended on Monday. The ruling BJP will be looking to defend the only southern state under its control from the Congress and the JDS. Well, let's now get on board Karan Taurani of Elara Capital to discuss how big a disruption will ONDC really cause when it comes to the food delivery market. Good morning, Karan. Good to have you on the show. We saw Zomato reacting to, the kind of disruption that ONDC is looking to create in the food delivery market. The stock was down somewhere around 6% in yesterday's session. And, ONDC, how big a disruption can this cause? It's an open source network. It's not really a platform. And, of course, we all know that the commission charged by the apps which host ONDC is much lower than what Swiggy and Zomato do. So what kind of a threat does ONDC really pose to some of these food delivery apps?
Hi, Nandita. Good morning. I think ONDC definitely is disruptive in nature. If you look at a company like Zomato, they were definitely moving very aggressively towards the path to profitability. And, we have seen the numbers, right? There's a turnaround. There's a clear shift in terms of how the EBITDA as a percentage of GOV is actually, kind of moving towards break even. And eventually we'll move towards a range of 4 to 5% as per management guidance. Now, very importantly, you have to study the levers here. Okay, so in terms of levers, take rates is the only big lever that they have. So if you look at the economics of the food business, I think delivery charges are more linked to AOV. AOV will not grow more than 4 to 5% in a market like India. And also you are expanding into tier 2 and tier 3 where AOVs are low. So because AOVs are not growing, delivery charges cannot move beyond the point. Currently, it's about 30-35 rupees on a per order basis. So that can't move up too much. In terms of the cost, you have got delivery cost per order associated. That can't change too much because that is something which you have to pay because of inflationary concerns. You can't save so much over there. Then you've got, customer acquisition, discounting, everything put together, which is right now, I think, come to a more stable level. I mean, you can't, kind of save costs there. So in terms of their levers or their path to profitability, it was very important to hike take rates, which, they were trying to consider to do. Now, what ONDC will do is that it will kind of disrupt the ecosystem in the form of, take rates actually may not be able to move up from here on. So in a best case scenario, Zomato would probably say, okay, fine, they are acquiring the customers, they are giving the last mile, they are giving the good customer experience. In a best case scenario, take rates will remain stable. As far as take rates are concerned, it's anywhere in the range of 20 to 25%. For the cloud operators, for the larger QSR chains, it's in the range of 14 to 16%. So the differential take rate which is there. So I think this will definitely have a negative impact in terms of the Zomato's path to profitability over the near to medium term. But the bigger risk or the bigger monitorable here is how does ONDC perform at a certain scale? So if you look at the numbers right now, they are very small. I think they are doing close to 2 to 3 million orders on an annualized basis. I know it's a very small start right now. But if you compare this to a Zomato, they are doing close to 550 million annual orders, on an average. So my point is that how does the customer experience, move on from here on? How do they actually have a control on last mile? And who is funding these discounts? I mean, the discounts could be funded, by the buyer apps. It could be funded by the seller apps. How long can this discounting proposition also continue? So I think these three, four are the monitorables in terms of actually getting what kind of impact ONDC can have on Zomato. But prima facie, it looks to be disruptive, provided the user experience actually moves up or moves in a better way, basically.
Right, of course, it has made an entry now. And do you think this, will it be easy to ONDC to actually eat into the market share of its incumbents, given the fact that, users have voiced concerns over delivery time and even the quality of food? Do you think these are just teething issues that will get ironed out over a period of time? Or do you think, it'll be difficult for ONDC to woo some of these Swiggy and Zomato loyalists?
So I think if you look at ONDC, I think it sits very favorably for the food segment. Typically, you know why? There are three, four reasons here. One is the average order value for food is phenomenally low as compared to retail, fashion, commerce, or any other segment put together, right? So there is this no issue in terms of trustworthiness because you're not spending a big chunk of money. Second thing is that whatever food has to come from a restaurant will come from that same restaurant. There's no issue that where will I get the food from or something of that sort. Third thing is that there is no issue in terms of after sales or returns, right? In the case of retail, fashion, 30-40% of your orders are actually in the form of returns, which go, and the reverse logistic cost is very high. So who actually funds the reverse logistic is the platform. So in this case, there's no such issue as well. So I think it is very apt and it is very well suited for the ONDC platform, given the kind of low order values that they have. So, which is why I'm saying that definitely there is a potential for food business to actually be more disruptive. I don't see consumers buying white goods or high value goods on ONDC because that requires some kind of genuineness, some kind of trustworthiness, and some kind of after sales service as well. So from a food standpoint, things look to be quite disruptive. But if you look at Zomato or Swiggy, rather, I think they've built a customer base over a period of time, and they have really got that experience in place. They actually know the customer very well. They kind of drive frequency of the existing customer in terms of providing them more offers, more variety in terms of food. Also for the industry, what I feel is that it's going to be disruptive in the form of cost of customer acquisition. So getting a customer on board now is going to be very easy because if you look at the likes of Paytm, Google Pay, all these large fintech companies, they have a user base of MAU of close to 200 to 300 million average active users. So I'm saying getting customers on board, getting a large set of customers on board is going to be very, very easy. But again, ONDC in terms of, how they move ahead, the path, obviously teething issue is, around the tech, user experience, how they resolve that, around lead time delivery, because it's very important to have last mile control in terms of how the food is delivered, whether it is delivered hot or cold, because that's a very important proposition. So you might get a customer because of discount, but that's going to be short lived. The customer will try your app, because of discount, but the experience is not good in terms of lead time, in terms of the way the food is delivered. The customer will not go to the platform back. So I think user experience is a very big key here. And what kind of investments are planned on that path from the platform's end, from the seller platform end, from the buyer platforms, and that is a very important monitor.
Right. Recently Invesco has slashed Swiggy's valuation by a third to $5.5 billion. And, do you think any such risk emerging for Zomato as well, given the fact that, that's the same method they use for deriving Zomato's valuation as well? Do you see any such risk for Zomato as well?
So obviously, I think Zomato and Swiggy have been a mirror as far as the broader valuation, growth rates, and the path to profitability is concerned. Even if you look at the delivery charges, you look at the discounting, it's very much similar on both the platforms. I mean, because they're duopoly right now, both operating at more similar levels. They don't want to rather compete with each other in a very big way as compared to earlier. So I think definitely this is prima facie going to have a negative impact in terms of Zomato valuation. But I think Zomato valuations will be at a premium as compared to Swiggy, because Zomato, apart from delivery, is also into food discovery in a very big way. And they have a very huge first mover advantage here as compared to a Swiggy. Plus, of course, quick commerce, which is there in the form of Swiggy, Instamart, and Blinkit, which is common for both. But Zomato, clearly, because of this experience around the discovery of restaurants, that is a value proposition that they provide versus Swiggy, and that's why they always will trade at a premium. But valuation impact is something which is going to be there in the near term. But whether this sustains, that is a monitorable, because as I said, discounts are very short lived. You can get a customer with discount for once or twice, But for the third time, the experience doesn't improve. The customer will not look for discounts and look for a better experience. See, because the digital business is all about economies of scale. You need to have the scale to invest into technology. Now, will this 2-3 million orders on an annualized basis, will it touch 100 million, 50 million? How much time does it take for that to happen? And basis that, what is the kind of investment required? And who will invest that money? Is it seller platform? Is it ONDC? Is it buyer's platform? What exactly happens? So too many question marks, for them also to really scale up in a very big way.
Right. My last question to you, earnings season is on. So what are your expectations in terms of earnings from the likes of Zomato and Nykaa this time around?
So if you look at Zomato, there is a clear focus here in terms of shift towards path to profitability. And if you look at the broader food growth rates, the food segment growth rates rather, they've been converging. So we do expect, the growth rates to be in the range of 20 and 25% on a YY basis. We believe that any kind of convergence of growth rates below this threshold will have a negative implication as far as valuations are concerned. As far as profitability is concerned, I think the food business is on the right path for Zomato. I think quick commerce is the only segment which is monitorable here. It's a very high fragmented market, too many large players there with very deep pockets, and they're already making losses of somewhere close to 1,000 crores plus on an annualized basis. So I think that is quick commerce is something which is monitorable in terms of how Zomato's valuations will move up from here on. As far as Nykaa is concerned, it's a very similar story. The BPC business numbers are stellar. They would probably grow at 27 to 26% in that range for Q4 on a YY basis, which means FY23 numbers would be somewhere close to 31-32% in terms of broader growth rates. That's where they have a competitive advantage. Tira, of course, is obviously launched by RIL Group, and I think how that pans out in terms of user experience, that's a multiple. As far as profitability is concerned, I think Nykaa also is on the right path, but they've been seeing certain pressures in terms of product down trading. And you could see margin under pressure on a Q-on-Q basis because we just come back from a very strong festive quarter as well. As far as fashion is concerned, I think growth rates therein have been subdued now because they want to focus on profitability, and they actually want to focus on the fashion losses actually coming down because fashion losses being higher are having a negative impact in terms of Nykaa's overall valuation. So that's how I see the Q4 results.
Right, so we'll be watching out for those Q4 results and of course touch base with you later when the results are out. Thanks a lot for taking out time this morning and joining us and sharing your thoughts with us, Karan. With that, let's quickly get on board. Our technical expert for today, Shrikant Chouhan of Kotak Securities, is joining in. Good morning, Shrikant. Good to have you on the show as always. How's the setup looking like for the Nifty today? Yesterday, we gave up most of the gains that we saw in the earlier part of the session. Do you expect the Nifty to edge back above that 18,300 mark or consolidate at current levels?
Yeah, good morning. See, I think for the Nifty, one thing is very clear that it is finding difficulties to sustain at higher levels, mainly because of weakness in the Bank Nifty. Yesterday, the Bank Nifty was on the weaker side. It failed to cross the level of 43,500. We saw a good amount of correction in PSU banks, and eventually the Bank Nifty closed below the mark of 43,300, which is slightly negative for the market, and that will push the market a little lower. Also, there are number of factors which are going to impact the market in the short term from the external side, like US CPI numbers are going to come today. Debt ceiling issues are there. Chinese economy data are not up to expectations. I think that is keeping the upside cap. But I'm of the view that in case if we see the market is crossing 18,350, which was yesterday's highest level, then certainly we are going to see further more activity in the market. In that, huge amount of short covering is not ruled out. But for the day specifically, we are expecting market to remain in a range of 18,200 and 18,350. If we see the market is closing below the mark of 18,200, then we should look for creating some short positions in the market.
Right, let's quickly talk about the stock of the day today. It's going to be Lupin, as I feel, because it's reported a 200 crore rupee profit vis-a-vis loss in the previous quarter last year, and even revenue and margins have been a big beat. If you look at the stock, it's gained somewhere around 12% over the last 1 month, started participating in the rally. What would you suggest investors do with this stock now? Is it time for a fresh buy or look at buying this stock on dips now?
Yeah, I think after a very long time, the stock has started moving upward and it is started participating in the overall trend of the market and overall trend of the sector. Numbers are also satisfactory, and I'm of the view that based on the technical formation, it is heading for the levels of at least 800. On the dismissal of 800, we can expect a good amount of price upward activity because below these levels, the stock has spent almost 1.5 years. So it is very important for the stock to cross the level of 800. And also, if we see the overall formation, I think investors should stay invested in the stock.
Right, stay invested in the stock. Even Apollo Tyres came out with its numbers, pretty good fold jump in profit. Tire companies on a whole have done pretty well. If you look at MRF as well, even that company has done pretty well in the quarter gone by. What would you advise investors to do with some of these tire stocks now?
Yeah, I think like it is very much, this particular sector is very much sensitive to the overall performance of the crude prices. And this time, luckily, we are seeing crude prices are sustaining below the mark of 80, which is positive for the sector. Also, rubber prices are down. And overall auto sector across the world, they are doing well. I think based on the overall news flow and the technical formation, we are of the view that it is heading for the levels of at least 420, 430 in next few weeks. It will take time. The reason is because the stock has already rallied from the levels of 300 to 380, 390. So if there is any correction, then we should be buyer. But at these levels, it is better to like hold long positions instead of creating any fresh positions.
Right, we had a couple of queries coming in on Apollo Tyres from Rohit Wig as well as from Dr. Sayan. Hope this answers your query. Let's take up the next query. This is coming in on MGL. And Funny PG wants to know if this is the right time to buy in the stock. Yesterday, we saw a smart 8% uptick on the stock after a great set of numbers. Would you advise investors to look at this one right now or wait for a dip?
I think it is better to wait. The reason is because most of the time, whenever the stock came to the levels of 1100, 1150, we saw good amount of profit taking in the stock. In the past, if we see the data of last at least 2 to 3 years, then 1100 and 1200 acted as major barrier for the stock. Yes, if we see any correction in the next few days or few weeks to the levels of 900 or 950, then there we should be buyer. But at these levels, it is better to stay.
Right. The next query is coming in from Khushi, and she wants to know whether Z could warrant a buy at the current juncture. The stock is down over 20% on a YTD basis, and it's been in a steady downtrend now. Would you advise investors to look at this, or is it time to stay away from this one?
I think it is like the most disappointing stock that I can say because whenever the stock has managed to recover from the lower levels, it found good amount of selling pressure at higher levels. And always there was like some lower top, lower bottom sort of series that the stock has formed. Currently also it is trading below all the important averages. But some few months back, 2 months back, the stock was somewhere close to 180 levels and there we saw good amount of inflows. So I think that is going to act as major support for it. We can keep 175 as a final stop loss for holding any long positions or creating any long positions. But in case if it breaks the levels of 175, then it is going to fall further. So yes, we can take some tactical call because the stock is oversold and it is very close to its important supports. But it is better to stay away from taking any investment decision.
Right, that's the call on Z then. Let's talk about Tata Steel then. We have a query coming in from Prashant and he wants to know your long-term view on the stock. The stock is heading towards its 52-week highs. Numbers were pretty encouraging. Time to take a position in this one?
Yeah, I think the way the stock has managed to survive above the levels of 100 when the market was down, I think certainly someone has taken a bullish call on the stock. And even if we go through with the fundamentals, then they are also improving. We are of the view that we should be buyer with a medium to long-term view, not with a short-term view, because the stock is not going to change the trend so easily. Yes, today's CPI inflation numbers are definitely going to support the stock if we see any fall in the inflation numbers. But broadly, we are of the view that if there is a view of next 3 to 6 months, then we should be buyer with a target of 130.
Right. Let's take up another query on HDFC AMC. This one is coming in from Suresh Shankar. Would you look at some of these AMC stocks now? These stocks were post the budget, a sort of an underperformance came in. But now if you look at the stock, it's Yesterday it was down 1% or thereabouts, and even over the last 5 days, just 0.5% gain or thereabouts. Time to look at these stocks with respect to buying for a fresh position right now?
I think, see, again, if there is a view of medium to long-term view, then only we should look for adding positions or to invest at current levels. Otherwise, it is better to stay away because it is not going to give you any major upward trending activity. Yes, the stock is very close to its yearly lows. In the previous year, in the month of May, the stock was somewhere close to same level, 1700. From there, we saw the levels of 23. Based on the current formation, I think the stock is recovering from the lower levels. And again, as I said, if there is a medium-term view, then yes, we should be buyer with a strict stop loss around 1650.
Right. I think we just about have enough time to squeeze in one more query. This one is coming in from Chirag, and he wants to know your thoughts on Venky's. Now, this stock is just coming off its 52-week lows and attempting to move higher. Over the last 5 days or so, it is just about flat, but in the last 1 month, it has gained somewhere around 5%. More upside on charts, given the fact that it is now off its 52-week lows?
See, based on the charts, the stock is very close to its long-term supports. In the month of December 2021, the stock was somewhere close to same levels. From there, we saw a sharp rally towards 4200, but now gradually again it is falling and coming back to the levels of 1500. So it is down almost what, two-thirds from the highs. I think at this level, certainly if there is a long-term view, then we should be buyer. Otherwise, it is better to stay away because all these stocks are like, it takes time until the stocks are not crossing any specific level. Based on technicals, it is better to stay away from taking any contra bets. But again, as I said, it is very close to its long-term supports. If there is a long-term view, then we should be buyer because mid-cap stocks are going to do well in the medium to long term.
Right, that was the call on Venky's. That I'm afraid we had only that much time to take up queries today. But before I let you go, Shrikant, leave us with some stock recommendations for our viewers for the day.
Yeah, I think all these pharma stocks are doing well. Most of them are recovering from lower levels whenever there is some sideways sort of activity in the market. We like Lupin Laboratories based on its volume and price performance. It is heading for the levels of 775. That's the view. We should be buyer at current levels with a stop loss around 725. The other stock which we like is L&T Mindtree, L&T Infotech Mindtree. Which is currently trading around 46.20, 46.30. Yesterday, we saw good amount of activity in almost all mid-cap IT companies, and in that, this stock has formed double bottom sort of formation. So to validate the same, it will move towards 4900. So with a target of 4850, 4900, we should be buyer with a stop loss at 4550.
Right, Lupin and LTI Mindtree are the two stock recommendations coming in from Shrikant this morning. With that, Shrikant, thanks a lot for taking out time and joining us this morning and addressing all our viewer queries as well. Well, before I wrap up, two important earnings to watch out for today. L&T as well as Dr. Reddy's, both the counters are expected to hand in a very strong set of report cards, with L&T handing in a very strong order book. So watch out for those two numbers later today. Well, with that, it's a wrap on this edition of Morning Trade. It's a goodbye from me and the entire team that put the show together. But don't go anywhere because coming up next is Opening Bell.